The share price of almost every dividend income stock has plummeted as 2022 remains to be a year marked by high market volatility. As a result, many dividend stocks are now giving dividend yields that are significantly higher than they typically would be. This creates an excellent purchasing opportunity for high-quality dividend stocks that are currently trading at a discount. But this year, certain dividend stocks have declined significantly more than others. That is why today, here on Usable Wisdom, we will dive deep into 5 stocks with a 15% yielding dividend. But before that, we would absolutely appreciate it if you subscribe to this channel and hit the notification bell. It's completely free, and you may change your mind at any time. That way, you'll be the first to know when we share new money-making ideas. So it's a win-win situation. Without further ado, let's proceed. MFA Financial will be our first stock to explore. This company makes investments in residential mortgage assets, including agency and non-agency mortgage-backed securities, as well as credit risk transfer instruments. When investing in these mortgage assets, this company, which is set up in the US as a mortgage REIT, leverages leverage. Since they were established in 1997, they are one of the more experienced M-REITs on the market. And as of right now, their stock is yielding 15.15%. We can notice some troubling patterns only by observing the share price performance of MFA. Even for REITs in general, which have recently taken a hit, their stock is currently down more than 36% for the year, which is worse than typical. The share price performance of MFA as a whole tells a rather terrible tale. This is a business that had a mediocre level of success in the industry from 1998 through 2020. Although MFA didn't have much growth, as is normal for an M-REIT, it did give a pretty excellent dividend yield, and it did manage to survive the 2008 financial crisis, in contrast to certain other mortgage REITs. However, this company was significantly destroyed in 2020, and it has since been enduring adversity. Without a question, the 2020 market crash cost a lot of investors a lot of money. They stopped paying dividends during the epidemic, but they have recently resumed doing so. However, they are now only paying little more than half of what they used to pay stockholders in dividends. The corporation performed a reverse stock split in April, which greatly dissatisfied many stockholders. They probably did it to try and stop their stock from declining any further, but it hasn't helped them yet. Examining their financial statements reveals even more alarming problems. It's not ideal if you're hoping for future dividend increases because their book value has been declining for more than 10 years. Next, let's look into Cherry Hill Mortgage Investment Corporation. Cherry Hill is a provider of residential real estate financing. They buy, invest in, and oversee residential mortgage assets in the US. The business makes investments in MBSs or residential mortgage-backed securities, as well as other assets related to service, like mortgage servicing rights. A comment from their website states that they aim to continuously produce enticing current yields and risk-adjusted total returns for our shareholders over the long term, primarily through dividend distributions. The CHMI stock is currently yielding a dividend of 15.84% for the year 2022, which is not as bad as other companies in this category. Looking at the share price performance of both businesses since their inception, we may observe a comparable pattern. Up until 2020, when they were hit particularly hard, both businesses were doing rather well and paying out substantial dividend yields. And as things begin to go down once more in 2022, we can see that both corporations are battling to return to their pre-pandemic levels. If we examine Cherry Hill's dividend history, we will once more notice a pattern of reductions. This stock's dividend reduction since its founding in 2014 has been around 4 times, which isn't as awful as MFA's. But MFA has existed for a lot longer than Cherry Hill. It distributes a quarterly dividend, the most recent of which was 27 cents per share. Their stock was paying 40 cents per share before the epidemic, a drop of around 32%. Again, in terms of how drastically their performance has declined, it's not nearly as terrible as MFA. We can once more find alarming patterns in Cherry Hill's balance sheet when looking at their financials. Between 2013 and 2017, their book value remained largely constant. But after that, beginning in 2018, they reported a rather significant decrease in their book value, and things haven't improved since. Following this company is Armour Residential REIT, ticker code ARR. In the US, Armour invests in residential mortgage-backed securities, or MBSs. Government-sponsored entities, or GSEs, in the United States make up the majority of the company's securities portfolio, and the securities issued or guaranteed by the government's National Mortgage Administration. They are supported by unsecured notes and bonds, as well as fixed rate, hybrid adjustable rate, and adjustable rate mortgages. As of the time this video was being made, their stock offered an amazing 17.65 dividend yield. Many people who are new to dividend or income investing choose to invest in this really well-known dividend stock. The value of Armour shares has decreased by more than 90% since their IPO in 2007. This stock's dividend has been reduced roughly 12 times during the past 10 years, which is quite awful. Naturally, their financial accounts portray a rather dismal picture. Similar to their share price, their book value has decreased by more than 80% over the past 10 years. This, of course, helps to explain the dividend reductions this company has been experiencing. Given their declining book value and their dismal net interest income, I can only conclude that things will continue to worsen. Before we proceed, please leave a comment below stating which country you are from, so that we may create more customized content for your location. With that said, let's continue. The next one is Icahn Enterprises. This is the investment company of Carl Icahn, and it owns companies in a variety of industries, including energy, automotive, food, packaging, and home fashion, among others. IEP pays dividends to shareholders every quarter and offers investors a dividend yield of 16.62%. This is a highly unusual firm that is very difficult to examine because you would need to look through the financials of every single company they own to see how they are doing. The company's structure as a master limited partnership should also be taken into consideration, as it will make tax preparation a little more challenging. You don't get a K-1 tax form from other companies, but they send one to investors. Compared to other companies we've looked at, the stock's performance has been noticeably better. Although there have been occasional spikes in the past, the share price has essentially been stable over the last 6 years. However, something that is quite impressive is that they have gradually been able to grow their dividend over the last 5 years, even if they haven't done so since 2018. Orchid Island Capital, with the ticker code ORC, is our final 15+ yielding stock. A specialty finance company in the US that deals in residential mortgage-backed securities, or RMBs. Agency RMBs, which are single-family home mortgage loans, support the company's RMBs. Traditional pass-through agency RMBs, such as mortgage pass-through certificates and collateralized mortgage obligations, are included in their portfolio. With a staggering 18.56% dividend yield, their stock has the highest dividend yield of any company on this list. Over 80% of the value of Orchid Island has been lost since their founding. Because Orchid Island has only existed since 2013, as opposed to Armour's IPO in 2007, it is actually worse than Armour. They pay dividends on a regular basis, although they frequently reduce them. As time goes on, they are becoming less leveraged. This decreasing trend has been visible since 2019. As the years pass, their book value has decreased. They have really never experienced a year in which their book value improved, which is crucial for businesses like MREITs and business development organizations. Both Armour Residential and Orchid Island, in my opinion, are deserving candidates for some of the worst dividend stocks available. It's quite apparent that each of these investments has a very high risk, while some are even higher than others. I would advise everyone to steer clear of these types of holdings unless they are willing to assume very high risk. The strongest stock on our list is undoubtedly Icahn Enterprises, but because it is an MLP and a very complicated business, I would only advise purchasing it if you firmly believe in Carl Icahn's approach to investing. No matter what, always do your own research and due diligence prior to engaging with any company. To lessen the amount of risk you are exposed to, Make sure to diversify your stock portfolio throughout various industries and holdings. Thank you for your time. We hope this video has enlightened you. And for more videos like this, don't forget to subscribe and hit the notification button. I'll see you in the next one.